Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Jack Mcdonald, CEO of Standard Custody and Trust, the Polysign subsidiary that provides a blockchain-based, institutional-grade custody service for investment managers investing in or trading cryptocurrencies and security tokens. Jack, thanks very much for joining us.
Thanks for having me.
Now, independent institutional custody has been in rather short supply in the cryptocurrency industry. That's made it very hard for institutional investors to, particularly most of them are obliged to use an independent custodian. It's made it rather hard for them to invest in the asset class. And I guess remains a problem in security tokens as well. So what are the institutional asset managers that you talk to telling you about what they need in terms of a custody service?
Well, as you rightly point out, this industry has been evolving and there's been a shortage of true enterprise grade institutional custodians. The industry really started backing retail investors, and it's only more recently that institutions have expressed an interest in investing into the space. And what they need is a custodian or service provider, more broadly speaking, that understands what the operational due diligence requirements are for institutions. And so it comes down to scalability, obviously security, which is table stakes in the industry. They are looking for applications or solutions that plug into the rest of their operational workflows. And very importantly, they need a service provider that is heavily regulated as well as insured. And at Standard Custody, we check all those boxes and then some.
You've also raised quite a lot of money, $53 million, if I'm right to say. Now,
we actually raised a little more. The Series B round, which we just closed at 60 million for a total of 88 million that we've raised to date.
Okay, so even more than I thought. Clearly, you've convinced some investors that you've got some big opportunities in front of you. Can you divide those between the short-term opportunities and the long-term opportunities?
Sure. The short-term opportunities, and really the purpose of the Series B raise, was to bring our Standard Custody business to the market. And that includes everything from hiring out the balance of the client-facing team, sales, operations, client success, compliance, also posting some regulatory capital. It's not cheap to do business in New York. And also, very importantly, to fund the future development of our blockchain initiatives, both for Standard Custody, as well as a broader application that we have with the parent company in Polysign to build out a settlement network for cross-chain interoperable transfer of assets. So a lot of R&D goes into that. Engineers are in high demand these days, and they tend to be rather expensive. So we'll put the money to good use. We also have very much global aspirations and want to have boots on the ground, both from a development standpoint as well as a client-facing standpoint in Europe and Asia.
One of the biggest investors in that 80-odd million is Cowen, the investment bank. And I assume that they are starting to see their investment management clients, their hedge funds that they service in their prime brokerage business and elsewhere, are actually active in the cryptocurrency trading and investment. Do you think that kind of combination, that sort of sell-side, buy-side combination, can drive growth in the security token markets as well?
No question about it. We've had over 50 calls with Cowen clients since we announced our partnership at the end of May. And the overriding theme of those conversations is a desire to do business with known counterparties. Having a familiar face across the table, if you will, has been a real catalyst for institutions to take a step forward to invest into the digital asset marketplace. And when I say digital asset, I include not only cryptocurrencies, non-sovereign backed virtual currencies, but also a full range of other types of digital assets that include security tokens. Having a fractional interest in a real estate property or a tokenized interest in a private company or a VC fund are all very much of interest to institutional investors, gaining more liquidity, more transparency, and more operational efficiency. And they want to do that through trusted counterparties, again, that are insured, that are regulated. And there's been a real dearth of those out there. Our partnership with Cowen will literally be the first investment bank sponsored partnership that enters into the digital asset space. So very, very exciting. We couldn't be happier with the partnership with Cowen. I find them to be an unbelievably agile, enthusiastic organization. They've been around for over 100 years, so a very trusted brand in the marketplace, but very entrepreneurial as well. So a win-win.
Yeah. Yeah, we've enjoyed working with them ourselves. Now you mentioned a minute ago that you'd received a license from the New York State Department of Financial Services to operate as a trust company. I hardly dare to ask this question, but why did getting a license from the New York DFS make more sense to you than getting a license from FINRA or the CFTC or the OCC or the SEC? There's so many regulations in the US. It's quite difficult for us not living there to work out why there are so many. But why did you opt for the DFS over those other bodies?
Well, it's certainly an alphabet soup of regulatory bodies there. And I think the taxonomy of the digital asset ecosystem plays into that. There's a lack of uniform view as to what these assets are. Are they securities? Are they commodities? Are they currencies? And the different regulatory bodies have different jurisdiction in the US. We took a step back and wanted to build a institutional grade custodian that could act as a qualified custodian, represent ourselves as a qualified custodian for institutional investors. And while obviously a global market that we will be serving in the US alone under the 1940s Act, the Investment Advisor Act, you need to use a qualified custodian if you are a fiduciary managing more than 150 million of assets. And so what that means in brass tacks for traditional assets in the US is you could either be a broker dealer, which is regulated by FINRA, you can be a futures commodity merchant regulated by the CFTC, or you could be a trust bank regulated on a state-by-state basis. To date, for all intents and purposes, FINRA has not allowed any broker dealers to custody digital assets, virtual currencies, et cetera. So that window is closed. The CFTC is applicable if all you want to service is commodities and commodity futures, whereas our remit was broader than that. So if all we wanted to do was custody Bitcoin futures, we could have gone to the CFTC. But because of our broader ambition, the state regulated trust banks was really the only way to go. And there's been 3 or 4 states that have given these licenses out: Nevada, South Dakota, Wyoming, and then New York. New York by far being the toughest hurdle to overcome, the highest regulatory capital requirements, the most stringent crime and cyber policies in the land. So it took more time, it took more money, but we think ultimately having that credential will afford us the opportunity to work with the best asset managers on the planet. And so now we're starting to look at what the similar sort of regulatory requirements will be outside the US.
Uh-huh. Just to be clear, that New York license entitles you to offer the services nationwide in the United States, does it?
I wish it did. All these states have reciprocity with other states. So with the New York charter, we are allowed to support another 18 or 19 states. And so we're in the process of getting a money transmitter license for the balance of the states that do regulate digital assets and crypto and require an MTL or money transmitter license. There are some states like California that do not currently regulate it. And so you can operate in those states without a money transmitter license. So within the next 6 months or so, we hope to be covering the bulk of the US.
And how liberal or restrictive is the license? What services does it entitle you to provide?
We're a limited purpose trust company. A trust bank is what we are. And that charter is somewhat dependent upon what the application is that we put in. So our initial application asked for regulatory permission to provide custody and escrow services for a broad range of digital assets. And that's what we've been chartered to do. We're in the process of going back to New York Department of Financial Services to broaden our mandate to support some of the other DeFi applications that exist out there. So it will be an evolving charter and an evolving relationship with the regulators. They want to make sure that we are thoughtful in terms of our plan to add new services or new assets. And so there will be an ongoing conversation with them as we evolve into this. Ultimately, we could broaden the charter, excuse me, to support fiat currency as well. Our current charter, part of that limited purpose moniker is that we do not custody cash or fiat currency for our customers. We do that through partnerships with other deposit-taking banks.
You describe it as a limited purpose bank. It didn't make sense to go for a full banking license.
Well, I think it's all relative. We do have a full, we are a bank, but that limited purpose we felt adequately met the needs for what we were looking to do strategically with the organization at this time.
Uh-huh. Now, you mentioned Wyoming as well, which has attained sort of poster child status in the industry, and almost everything you read emphasizes this bailment law, so you can continue to to control your assets, even when they're in custody. You weren't tempted. You've explained very clearly that going through the New York process was the most demanding, and therefore offered the maximum assurance to the potential client base you had. But you must have looked at Wyoming and Nevada and these other places and decided whatever they offered wasn't sufficiently attractive to warrant going there as well. Does it even make sense to think about getting additional licenses from them, or do they offer any advantages which made sense to you?
Well, I think speed to market was certainly an advantage that we could have gone to with our view was that we wanted to ultimately build a solution that would allow us to be able to work with other New York regulated financial institutions. So, for example, acting as a sub-custodian for a large global custodian that's regulated in New York, they're going to have to look to other New York regulated financial institutions. And so we can raise our hand and be nominated for that. We also felt like coming from New York would be the strongest posture for us to ultimately apply if the environment supports it for a national charter from the OCC. And we do think that there would be a halo effect, frankly, from being in New York relative to some of the other jurisdictions, taking nothing away from them, but we just know where the where the concentration of institutional asset managers are in the U.S. So had we gone to South Dakota or Wyoming, for example, we would have been precluded from servicing a client in New York unless we went and got a separate BIT license from New York. To date, the New York regulators have not been giving out licenses to trust companies that have been chartered in other states, whether they view that as a bit of a circuitous route to getting an application in New York as opposed to going direct to New York. So we strategically felt like going directly to New York would be most advantageous for us. And we certainly feel comfortable with that decision and are glad we did it.
Mm-hmm. Certainly making it sound as if where you get your regulatory license is quite an important competitive
no question
consideration.
No
but
question.
it's as you look at the e-industry on a sort of global scale, it's quite a complex but also quite competitive field now. Banks like Avanti and Two Oceans, who did decide to go the Wyoming route. We have been talking to Hex Trust and on-chain custodian in Asia. We talk regularly to Trustology here in the UK. We've seen Northern Trust and Standard Chartered come up with Zodia. We've seen BNY Mellon invest in Fireblocks, and we've seen State Street now announce a digital unit. So we're seeing the traditional global custodian banks and some of the major brokerages getting into this business as well. As you compare yourselves with them, what would you say is your chief competitive advantage?
There's a lot of content in that question, Dominic. So
Sorry.
Let me answer. No, they're all good points. Most importantly, I think our chief competitive advantage is our people and our technology. We, from a leadership team standpoint and an overall team perspective, we really approach this from both a traditional capital markets and finance standpoint, as well as from a blockchain cryptography standpoint. We find that many of the competitors are very strong in one or the other, but not both. Our founder is Arthur Brito, who is one of the three co-founders of Ripple, responsible for designing and developing the XRP ledger, which compared with Bitcoin basically exceeds every measure around scalability, throughput, speed of transactions, cost effectiveness, environmentally friendliness, et cetera. We also have David Schwartz, who is on our board and an investor in the company, a strategic advisor. He's the current CTO and chief cryptographer at Ripple. So these guys are real rock stars in their field. I come from a traditional finance background, having run a company called Conifer before a successful exit. We have Tim Keeney, whom you know, who casts a very long shadow in this industry, ran all asset servicing at BNY Mellon for 12 years. So we really feel like we understand how traditional finance and capital markets work, but also really on the cutting edge of cryptography and blockchain. So we bring that to bear. We are the only custodian in the industry that has a native blockchain at our core. We think that that's a true differentiator from a security standpoint, but also from a regulatory compliance standpoint. And that is objectively different. We also approach the whole approval process in a very different way than our competitors by really outsourcing and distributing trust. And so we want to displace trust with truth and feel like we've done that with our application. The other thing I would note is that the big banks are coming out with lots of announcements. I think you're noticeable in your absence if you're not coming out with a statement saying we're going to start providing access to digital asset investment opportunities for our private wealth management or PCS clients. You're noticeable in your absence if you're not putting together a SWAT team of blockchain experts to understand how you are going to adopt this new technology into your organization. What actually happens behind the curtain is different. We've talked to most of the larger banks at one form or another at different points, and there's lots of pockets of interest and development going on, but it's tough for these large organizations to come up with a unified strategy of what they want to do to bring their organization into the digital asset age. And I think most of the large service provider banks are trying to decide whether they should build it on their own. Very expensive, time consuming, shortage of talent, frankly, engineers who want to go work at big banks as opposed to work at startup companies like ours. Do they want to rent some technology, licensed technology like BNY Mellon is doing with Fireblocks, then building a solution around that? Or do they want to buy, do they want to make an acquisition of a Fireblocks or a company like ours? And I happen to think you'll see a big M&A boom here in the next 3 to 5 years once institutional demand gets to the point where there's no turning back. And we've been told through our investment opportunity from some of the large banks that they would rather pay more later than pay less and be early. So time will tell. It's an exciting space, to be sure.
All right. So standard custody and trust being sold to a major global custodian bank in a few years' time is one exit for your investors.
It wouldn't shock me.
Yeah. Now, you brought up the question of the technology and made a very persuasive case. You've got some very smart people working for you, are able to attract engineering talent as well. And since you brought it up, let's talk about it now. You mentioned throughput and speed. You've solved those. Now, one of the classic engineering problem with blockchain is that lack of scalability. In Bitcoin, it's the 5 to 7 transactions a second. With Ethereum, it's like 16, 17, 18 a second. So people have found it very difficult to adapt blockchain technology to institutional scale volumes. Are you saying you've solved it? And if so, how did you solve it?
Yeah, it's part of the secret sauce, frankly, of what we've built with the blockchain. One of the things that we do in our custody solution is we actually run business logic through HSMs or hardware security modules. That business logic is stored on our chain and developed there. We have a proprietary chain. Very importantly, we're not storing any assets on our blockchain. So it's not this centralized private chain that would concern people. But we built a chain specifically to provide end-to-end encryption. Throughout our process, we store secrets on our chain, and we are able to overcome what's historically been bottlenecks in terms of HSM speed and processing of transactions. Arthur and David spent a lot of time developing it. We were fortunate to be well-funded early on, so we could take our time to develop what we believe is a best-in-class solution, something that we believe has impressed the regulators and the insurers in terms of bringing our product to market. We're the first company that has ever received a de novo license from the New York regulators to provide custody. So we did not have a pre-existing business like a Fidelity or a Coinbase. But that's been, what we've been working on from an engineering standpoint, and believe that we can support unlimited transaction volume by use of our private blockchain.
I detect the influence of David Schwartz in what you were saying about end-to-end encryption there. I think a lot of people listening to this will just be wondering how you've solved that key problem about keeping the private keys to these assets secure. Obviously, in cryptocurrency, the native assets, if you lose it, it's gone forever. Security tokens, you can replace them and so on, but you still have a variant of that problem. Can you tell us a bit more about what technologies you're actually using to safe keep the assets? The debate here is usually about, is it cold storage? You've stuck it on a USB stick and put it in a safe. Yeah. It's about multi-sig. It's about multi-party computation. Can you tell us a bit more about
it's a little bit of all those things, and we've been fortunate to witness all the different companies that are evolving different things, and I think we have a bias towards developing most of our tech in-house. We have, for example, MPC. We met with a bunch of the Israeli MPC companies a number of years ago and decided that we would rather control our own destiny, and so we built our own MPC algorithmic logic that we use in our solution. We do use HSMs. We use multiple vendors. We support them in various colo facilities. So really want to distribute the risk there. We use threshold signatures. We do have a multi-sig component to what we do, both at the client level where transactions are proposed and approved. But then when the approval comes within the four walls of the custodian, typically you would see the custodian then sign off on the transaction. We distribute that risk to third-party verifier firms who are service providers to the industry, who essentially get alerted that there is a transaction pending their approval, and they would be responsible for reconciling instructions, transfer instructions, essentially in a sharded sort of environment. So you would have one, I would have one, we don't know who each other are. And once the requisite number of approvals come together, then the asset can be transferred. So that's a unique way of doing that. We've got some biometrics involved in terms of video authentication, voice detection, et cetera. So a number of different components that all come together in this symphony of security, and all able to move a transaction within 3 to 5 minutes max, if all the counterparties are lined up. So designed to be very agile. We're not a high frequency trading solution. We are developing some hot wallet solutions that could be a non-custodial sort of application. And as I referenced earlier, we're also building out on a separate blockchain, a settlement layer. But our core custody, you can think of as really better than cold storage. That's the way it's been treated, by the regulators and insurers. And we do have a network component. So in the legacy definition of cold storage, we are not, but we're not the only ones in that regard either. And we think having a network component is actually advantageous in terms of being able to move the asset more fluidly.
I'll come back to that point about biometrics in a minute. Can I just ask you one other question? You mentioned this in-house bias in your technology. Now, is that a problem? If you're creating a lot of proprietary private blockchain technologies, does that make it more difficult to interoperate with other blockchain networks? And it's obviously something you're going to have to do as the business grows.
We've designed our product from day one to be completely interoperable. We're not one of those blockchain companies that says our blockchain's the best, move your assets off Bitcoin or Ethereum, et cetera, and move it to us, and we're going to be the best blockchain, the universal source. Quite the contrary, we've built our chains to be interoperable with other blockchains. And we really want to be essentially a messaging layer, a connective tissue between different chains to allow for a better custody and settlement experience cross-chain. And so we're asset agnostic and we're blockchain agnostic. Mm-hmm. We do have a bias towards developing what we feel we can do better than third-party applications. We also are very mindful of controlling our own destiny. David and Arthur are confident in their abilities. They're also humble to know where it makes sense to outsource. So, we use a lot of open source code. We use third-party machinery, obviously like the HSMs. So there's a mix of third-party vendors as well as in-house. But we're not stitching together a bunch of third-party applications that anybody can buy and bringing that to the market in a wrapper. We've got core technology being developed in-house, and we do think that that's a true differentiator for us.
You use the term truth, not trust, and you referred to biometrics as well. And obviously the classic blockchain was all about a trustless environment. You're dealing with institutional money. Institutions want to know who their counterparty is, as you pointed out earlier in the shape of, in our discussion about Cowen. Now, working out who is a trustworthy counterpart in the traditional industry has become a very tiresome process in terms of these KYC, AML, CFT, sanctions, screening checks, very tiresome, very expensive. Do you have a well-developed view about the value of digital identities in digital asset custody?
We do. Obviously, from a regulatory standpoint, we flock to the highest regulator in the land. So we take that part of our business very seriously. We've invested in regulatory compliance really from day one. And so everything we've been built has been purposeful around that. One of the applications for this second blockchain we're building is very much, as you suggest, premised on digital identification and delegation of signing authority. And so we think that there are a lot of advancements that will take place in the industry using blockchain technology for identity management and authentication. And so we very much prioritize this notion of being able to validate and verify that I am who I say I am, and doing that through a number of different applications, and then storing in an immutable and auditable way that information on our chain is one of the core applications of our private chain within the custody business.
Now, can we go back to the underlying business? you have this integrated escrow platform. Escrow is a term we hear a lot in an American context. It sounds rather odd to European ears. What's the necessity for that? What's the advantages of it in this marketplace?
Well, and this was quite popular a couple of years ago, and I think it's evolving a little bit more and more now. But this notion of two counterparties who want to trade, who may not know one another well, and trying to solve for this notion of who goes first. We can support a transaction, whether it's fiat to crypto, crypto to crypto, or crypto to fiat, and do that within the walled garden of our regulated and insured custodial platform. So it's essentially an off-chain or off-exchange transaction, an OTC transaction, but you can do that in a trusted and insured manner. And so that would be the use case for that.
All right, I understand. So now, if the security token markets take off, security tokens are going to be a bit different from cryptocurrencies. They're going to need servicing,
right?
And that servicing is going to come through smart contracts, right? So, what's your model here? How are you going to improve on what's and I guess we'll come to this. How's it going to improve upon what custodian banks are doing already on the asset servicing side in terms of collecting income and tax reclaims and voting proxies and processing corporate actions and so on? And it's all being done by smart contracts.
Yeah, at the broadest level, we think we're playing a vital role in replatforming the capital markets as we know them. And we're not going to do that single-handedly by any stretch, but we do believe that there is going to be this evolution, not revolution, but an evolution towards digitizing much of the operational flow of what happens today in the existing global capital markets. So security tokens bring forward the need to modify the asset servicing that exists. Now, both Tim Keeney, whom I referenced earlier, and I both come from a broad asset servicing background. And we like to think of this surround sound of services that complement core custody. Core custody in a digital asset sense, as we've been speaking about, requires a whole different level of technology that underpins your whole asset servicing business. And so once you get core custody right, the opportunity exists for you to repurpose all those other service lines that you have, whether it's collateral management, treasury services, fund administration, lend, borrow, et cetera. And one of the things we're seeing anecdotally with Cowen is a desire for them to repurpose their capital markets business, their global markets business. They want to do everything they're doing for analog, if you will, the traditional equity and fixed income markets, and do that in digital as well. If you think of digital as being really a new asset class, they want to be a full service bank supporting those assets in the same way that they support the traditional capital markets today. And so we think that we will be a bit of a Trojan horse for large organizations who want to reimagine what their business would look like servicing digital assets, but it all starts with custody. And so that's what we started first with custody, always with an eye towards how these other services would complement that. And ultimately, while we don't think about this on a daily basis, I think the global banks are going to look at firms like ours as a ideal tuck-in acquisition upon which they can build out these other services.
Now, security tokens may be in the foothills, but one area where tokenization is quite a long way up the mountain now, obviously, is DeFi. We've got people just depositing cryptocurrency, getting tokens in return. Some of them is getting stable coins in return. Is that an opportunity, a short-term opportunity for standard custody and trust?
I think it's a long-term transformational opportunity. And I think ultimately, if I look out 5 to 10 years from now, I think the non-crypto side of the digital asset ecosystem will actually be larger than crypto today. If you'll allow me the definition for cryptocurrency to be a non-sovereign backed currency, and if we think about digital assets to include not only the cryptos, but security tokens, central bank digital currencies, fractional interests in different assets, private company shares, et cetera. I think that segment of the market is going to explode. I think we're maybe in the first inning. I don't know what the cricket analogy of how many innings you guys have over there, but in baseball, we have 9 innings. So I think we're very early on in those days. And I think DeFi is a very, very powerful movement where people are seeing the opportunity to really take control of fully servicing the assets that they own and doing that in a more of a peer-to-peer way and less in a centralized counterparty way, and being able to monetize that. And so it's a innovative space. It's early. There's lots of companies that are trying to add value, and we certainly want to be constructive in that regard, and we're thinking constantly about other services that we can offer, other firms who have a excellence that we can partner with. We're not going to do this alone. It's really a community based solution that will ultimately, I think, service the market best.
Yeah. Now, you're obviously talking to lots of people. Can you tell us a bit about the use cases you're actually working on? And I asked this question knowing that in the tokenization space, the two big opportunities that have been identified already are commercial real estate and privately managed assets, which would include private equity and VC funds, as well as privately based bonds and all the rest of it. Are those the sort of opportunities you're looking at servicing as well?
We want to service real world use cases and develop applications that are needed by the market and wanted by the market. We don't want to be a technology looking for an application. And to that point, we've been seeking out partners for proof of concepts to assist us with the development of our settlement layer. We have several POCs going on right now. One in your backyard there in the UK with a very large global asset manager who believes that the future for their business is going to be developing more products for, as they refer to them, the man and woman on the street who are looking to get access to alternatives, but don't have the legacy appetite from a capital allocation standpoint and from a investment duration to be able to invest in traditional institutional products. And so together with them, we are helping them build a digital retail feeder fund into an open-ended institutional real estate fund. And the idea is that ultimately retail investors could buy a tokenized interest in this fund. This token would trade on an exchange. So the end investor could get liquidity and greater transparency into what they're owning rather than tying up their money, even if they could afford the hurdle, tying up their money for 10 years. And we think that's a real harbinger of things to come. We're working with a top 5 global bank who does a lot of the asset servicing for them. We're the platform essentially that is a messaging layer between the issuer of the asset, the transfer agent, the fiat custodian. We're going to be the security token custodian. We have an exchange listed in the UK, the first listed exchange for digital asset trading, who is going to trade the token. And so that's one example where we're building out this sort of ecosystem. We also have several VC funds that we're talking to here in the US interested in doing a POC around a fractional interest in a sleeve of a fund that they have created. And once again, similarly, creating greater access to liquidity and transparency for smaller investors to be able to participate in this type of alternative asset class.
So we've got mutual fund managers, if you like, thinking about creating a token share class in existing funds. We've got private equity funds looking to tokenize a sleeve of a particular fund as well. So fund managers of all kinds are clearly a big opportunity which you have identified. Now that's an industry which, and you'll know this, having worked at Conifer and seen it at first hand. You've got custodians, you've got fund accountants, you've got transfer agents, you've got independent distributors, you've got fund platforms, and there's a lot of intermediation in that business. So when you start talking to these asset managers about the advantages of doing this, you've been very clear about that it's useful in terms of asset gathering. You can reach new types of clients, those men and women in the street. What's the real selling point to them from an operational point of view?
Certain asset classes outside of vanilla equities and fixed income are equally burdensome for both the buy and the sell side to service. Having run a fund administrator and a broker dealer, I know how difficult it is when, relatively speaking, when you get a real estate asset or a private company share and it just doesn't scale through your operations. We had instances where different VC funds or private equity funds, the fund administrator that we had at Conifer, different funds could own the same asset, but the valuation and pricing policies that they had called for different marks. So, companies, SpaceX could get a mark for one investor that would be different than another, as opposed to, I've got 20 clients who all own IBM stock. I get one price from the New York Stock Exchange through my Bloomberg feed, and I run it through the whole factory, and everybody gets priced the same way. And so it's almost a manual nature that's required by some of these less liquid less transparent asset classes. You have to go out and hire a valuation agent to go and see what the office building at the corner of 57th and Madison Avenue is worth. And that doesn't scale. And so if you can take that office building, and if you could tokenize it, and now there's 100 tokens that represent ownership in that, and there's an exchange where that traded, now every time one of those tokens trades, each one of those 100 token holders get a new mark. It's transparent. And if you were doing the valuation or accounting for that, you would be able to scale that in the same way that you scale efficiently your equity processing business. So I guarantee you, Dominic, if you went and talked to the BNY Mellons, the State Streets, the cities, you name it, and looked at their asset servicing business, they're all looking at a business that is under pressure from a fee perspective, while the costs are going up and the fees are going down. And yet more and more investors are trying to invest into these asset classes. So knowing that, we identified a couple of asset classes that really represent the low-hanging fruit here that would benefit by greater transparency and liquidity, frankly.
Yeah, no, I see how liquidity actually makes life easier on the operational side as well.
For both the buy and the sell side, though, to your question.
Yeah. Now, looking forward, is your focus going to remain institutional, or are you thinking in the long run of servicing retail business? We've talked about men and women in the street. Is that?
Yeah, we're really institutionally focused. You know, we have an extremely robust infrastructure that we've built. And while it certainly could support a retail sort of flow, our customers are more at the enterprise level. Now, that said, many of the customers that we're talking to today and will likely be supporting in the near future have a retail business. We'd rather have them service the last mile, if you will, of the retail flow, but us look at them as a institutional counterpart, almost as a treasury account for us that would value, frankly, the sort of scalability and security thresholds that we've built, and then that they can then service unlimited number of customers on their end. But we would rather face off against them than the individual retail client. All that said, this industry changes quickly. So as far as I can see, that's my answer. But I'm also humble enough to know that the sands change quickly here.
Now, I think you've said this, but you are planning to offer a service outside the United States. You plan to go global with this, yeah? Oh,
absolutely. I mean, you know, part of the beauty of the crypto markets, blessing and a curse. You know, you can never sleep. 24/7 markets. You know, no holidays, no breaks, no weekends. So it can be taxing for those of us in the industry, but it represents a major opportunity, and we would be, I think, remiss in not trying to service the globe with our solutions.
Do you know when you're going to start, or where you're going to start? You're going to come to London, or?
Oh yeah, we definitely are already with the POC that we've got going on in the UK. We're looking at establishing a European corporate presence as we speak. We've got investors in Europe and in Asia, and they were strategically chosen in part because of the breadth that they can help us, you know, generate. Cowen's got a presence in the US. I'm sorry, in the UK. So we're looking to leverage that relationship. Blockchain.com, another investor in our Series B, a major presence outside the US, particularly in Europe, that we're looking to leverage. So we very much have a global view in terms of how our business will evolve.
Mm-hmm. Now, you've mentioned how difficult it is for the global custodian banks to attract the engineering talent they need to, I don't know, turn such large organizations around, to point them in different directions easily. They're not naturally nimble, are they? So when you talk to them, or when they ask you questions about what you're doing, and maybe in 5 years' time they can buy you and get what they need, but over the next 3 to 5 years, what's your message to them? Is this going to be all about how it's going to save them money? Is it going to be something they have to do, or they're going to be driven out of business? Is it a huge revenue opportunity? What's the positive or negative message for global custodian banks wondering what to do about what's happening in crypto, in DeFi, in security tokens?
I think it's all the above. I wouldn't suggest we're going to drive them out of business, but it's certainly speed to market. It is gaining access to leading technology and gaining access to leading developers, frankly. And so I think the big banks are trying to anticipate when demand for these types of products and services is going to hit their front screen. And it's starting to happen, clearly. Some of the largest, because we're talking to them, asset managers are looking for solutions. And you can't build this type of solution overnight. And so whether you start with us as a sub-custodial relationship or whether you license our technology as more of a kind of precursor to having your own technology, I think those are the conversations that I see us having today and will continue to have into the future. So we're in this kind of preliminary phase, I think, for a lot of the big banks, again, as they're trying to think, and leadership changes, and there's different pockets within the organization who have different needs, different regional focuses, but whether they build it, whether they license or rent it, or whether they buy it, seems to be a topic of conversation at most of the large banks. And we would say license our technology or appoint us as a sub-custodian, where you can put your wrapper around us, you can go to market, you can service your clients, and we'll see where that takes us. But we're very interested in those types of relationships.
Now, Jack, one last question for you. The big banks seem to have got there in terms of cryptocurrency. They've got buy-side clients forcing them to develop products to service them in that area. Now, security tokens are still very, very small. My question to you is, how big could they get and how quickly? And I ask you that question in the light of an organization as conservative as Swift, for example, has said that it thinks that security tokens could be half the size of the security markets today within 5 or 10 years. If you consider the equity markets around the world are now 100 trillion, the bond markets are 90 or 100 trillion, even if they were 10% the size of it, you're talking about $20 trillion opportunity. What's your guess about how big the security token markets could get and how quickly they could get that big?
I think Swift could be sandbagging their answer. I think I very much agree with them. I think the whole capital markets as we know it is going to be transformed and is going to be digitized 10 years from now. Now, how that's going to look 2 or 5 years from now has yet to be seen, but the world is absolutely changing. All the analogies around the train has left the station, et cetera. It is undeniable in my mind that the world is going digital in terms of capital markets specifically, and that asset servicing as we know it will fundamentally change. There's no reason we have to have T+2 settlement in the US, other than having been built on legacy infrastructure and architecture. There's also, I think, a vested interest in having a delayed settlement period. There's a lot of hands in the cookie jar who enjoy the float over that time. And there are other fundamental reasons from a investor protection reason why having a delayed settlement can have merit. But I think fundamentally our ecosystem in capital markets globally will operate much more efficiently and accrue to the benefit of end investors if we could utilize distributed ledger technology and blockchain technology across the board. If we can tokenize and digitize securities, non-security assets, bring greater transparency and liquidity to the marketplace, open up investable assets to a broader range of people, and doing that in a very regulated and compliant way. I think the future is extremely bright. I think it's a super exciting time to be in this industry, and I couldn't be happier to be at the helm of Standard Custody.
Jack Mcdonald, thank you very much.